Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day, about 10 to be precise. It's time for the big picture. Let's welcome in the team from Charles Schwab. Cooper Howard is Director and Fixed Income Strategist at Schwab Center for Financial Research. Michelle Gibley is Director of International Research at Charles Schwab. Cooper, Michelle, great to have you both here with us. Cooper, let's start with you and talk about the action we've been seeing in the bond market today. We haven't touched on it yet in today's show. 10-year yield on the rise, trading around 4.34%. Tells you what?
You know, I think longer term, if we look at the direction of Treasury yields, I think our expectation is that they're going to continue to chop sideways. So I think the intraday moves, it seems that the market's really moving off of headlines, potentially. I think the big overhang, like Scott in the previous session says, is what happens with tariffs. We got some potentially good news about tariffs being rolled back a little bit or trying to make deals. So I think that that's a positive, but overall, there's just this kind of looming issue going on in terms of the bond market. And I think longer term, what we're looking at Caroline, is that it has the impediment to slow growth. So we do think that the direction of Treasury yields longer term is likely to be lower, but how quickly do we get there? I think that's the big question that the market's trying to digest right now.
Okay, so the market wants to know what happens with tariffs, Cooper, but also what happens with the Fed this week, largely expected to stay put in terms of rates, but any sort of commentary on the outlook for future rate cuts. And I was just taking a look at the CME FedWatch tool, Cooper, and now there's a 70% chance or 72% chance that the Fed will stay on hold in June as well.
Yeah, so for this upcoming meeting, I expect that the Fed's going to serve a nothing burger. We don't expect any change with the rates, as you mentioned. I also expect that the statement's going to be pretty benign, likely no major changes there. And then keep in mind, this is a meeting that we don't get the summary of economic projections or the dots plot. So it's going to be lacking in terms of a lot of information. I think during the press conference, however, that's going to be where we get some information if we do. But I'd largely expect that Chairman Powell is going to preach from the same playbook that he has been preaching and suggest that they're going to be patient in terms of cutting interest rates. Now, Caroline, our view is that the Fed is going to continue to cut interest rates this year. Right now, the market's betting about 325 basis point rate cuts prior to year end. I think that's a little aggressive unless we see a slowdown in the labor market. So in terms of what we expect to see in the upcoming meeting, probably a lot of nothing.
Okay, so some tariff clarity could certainly help the Fed determine the policy of interest rates, Michelle, and might soothe the markets as well. We know that there's been a lot of uncertainty, but you say that uncertainty for businesses and consumers could linger. Tell us why.
I think that any kind of de-escalation, any kind of words like making deals or talking or negotiating, those are good for markets, but you know, we could get these like frameworks or memorandums of understanding that really are not deals per se, but they are just more what we're going to talk about when we do have a deal. And they could result in another extension of the 90-day pause past July 9th. You know, the average U.S. trade deal takes 18 months to sign, and we're trying to do a bunch of countries all at the same time. You know, and for some of these countries, there could be pressure for them to decouple from China, and many of them cannot do that without economic harm. And then, you know, these very high rates that we're seeing between the U.S. and China, they really need to be reduced for the uncertainty to meaningfully decline. And I think this idea, you know, we're talking about talking, that's great, but thawing of relations may center first on the removal of preconditions each side has made to start negotiations.
Okay, so Michelle, trade policy isn't just influencing action at the Fed, it's really influencing action at central banks around the world. Is the expectation that inflation is going to increase or decrease because of tariffs?
Yeah, I think that, yeah. You know, trade policy is influencing central banks globally. We had the Bank of Canada pause in April. That was kind of surprising. They used trade uncertainty as the reason. Last week, the Bank of Japan reduced its growth and inflation targets. They did not hike rates. We weren't really expecting them to, but that decrease in the inflation target was a little surprising, and people are reducing their expectations for Bank of Japan hikes because their inflation has actually gone up recently. In Europe, the ECB cut rates in the middle of April and listed downside risk to inflation. Of course, their inflation is already quite low at 2.2% in March and April. And then this week, we'll have the Bank of England. They're likely to follow this mostly dovish response we're seeing by central banks outside of the US. And, one thing to think about for these central banks overseas is that many countries are seeing stronger currencies. We see a rise in the pound sterling, the euro, and the yen. And that pushes down import prices and inflation. And then, of course, the trade war is likely to weaken growth as well. So they're more able to cut rates at this point.
Okay, so Cooper, what's the takeaway for bond investors as they think about the Fed and the meeting that kicks off tomorrow with the decision on Wednesday?
There's obviously a lot of uncertainty, but I'd also highlight that there's a lot of opportunity. We still are seeing elevated yields, like you mentioned, Caroline. 10-year Treasury is about a 4.30. But I also think one of those areas of opportunity that I'd like to highlight is the municipal bond market. On a broad index, you can get about 4% in terms of the yield. And that's also tax advantaged. So generally speaking, that's something that you don't pay federal income taxes on or state income taxes. Credit quality is fairly high in that part of the market. So we do think that that's an area of opportunity. So even though there's a lot of uncertainty, we do expect that yields to chop sideways and bonds to be volatile. I would still highlight that there is opportunities out there.
Okay. Cooper Howard, Michelle Gibley, thank you both so much for your insights.